it or just me next time too?
Well, I have to do some research first.
Yeah.
All righty.
I love the title of this, Stephen.
Yeah, I this has been maybe the most difficult economic environment since I got in the business in 1981. And as I was thinking about what to talk about this week, I was thinking about the things that I got wrong and wanted to just kind of review the things that surprised me this year. So we'll jump right into it. I want to cover three things. Start with just where we are with the global backdrop. I want to talk about the EU and China, which are the two areas that I got most wrong, I think, for what's transpired there. And then I want to suggest that people start moving to the other side of the boat because it feels like there's too many people leaning on one way. And I think we're moving to a period where you want to move away from the crowd a little bit more aggressively. So let's jump into it. As you can see, the real GDP, whether it's around the world, which is projected to grow around 3%, or in the emerging economies is still quite strong. In the advanced economies, the US and elsewhere, we're looking at really just under 2% growth. Maybe it'll be 2 to 2.5% growth, but certainly not a particularly strong period of growth, but coming into the year for where people thought we were going to be, certainly better than people were anticipating. And I think that's in part because the headline inflation has come down maybe a little bit faster than a lot of people have thought. We were very fortunate to have a warmer winter, which helped ease some of the energy inflation pressures, but we still have food and wage inflation still high, and we're not out of the woods yet on the energy transition. So I think you can't be too complacent about where we are with the way inflation has come in. Although I think that we have seen.
Hey, Stephen, your slides aren't advancing. I just wanted to.
Okay.
It's minimized, I guess.
All right, let me try this again then.
Well, just so you know, Stephen is known to stay on the first slide and do an intro.
That's not what I'm doing now, though.
Okay.
Having trouble with my slideshow here.
He's also known to let me run his slides when he
Let me try it again.
take two.
As I said, his origin is old-fashioned liberal arts, which means not technology, not engineering, and not running slideshows. And as the CEO of a substantial enterprise, you would think he'd have somebody else doing this for him. Apparently he's just hadn't figured it out yet. But he's
Yeah,
only,
I've
you know,
done
he's
this
only
on my own
middle
for
age.
quite some time, and it seemed to work. But
Yeah.
my troubles today. Mark, if you want to run them,
Yeah, hold on. Here's what I'm going to do.
I stopped sharing.
All right. Let me go find your file in a second. Well, can you carry on for 60 seconds? I will have it.
Yeah. So I think you can't see it, but headline inflation's come down pretty much around the world. And I think that's one of the things that has caught people a little bit by surprise is how quickly it's come down. I think that's taken some pressure off of the system, but not quite enough, because I think the other side of that is we had the short-term policy rates move up so fast and so aggressively over the last year that is part of the reason why inflation's come down. But I think the adjustment process to the higher rates is really one of the elements of what we have going on. And that's really moving from 0 to 5% as quickly as we did has been a very difficult adjustment for investors as well as for policymakers. And I think most importantly for corporate executives who are trying to figure out what's their cost of capital, what do I invest in, and what are my opportunities to invest there. So Mark, we can jump to slide 5.
Okay. This slide?
No, the next one. So you can see the sharp move up in policy rates has been something that I think has thrown people off in the markets. What you are starting to see, though, is a divergence where the emerging economies are starting to cut rates again. I don't think you're going to see that in the US or in Europe. And I think the market is really coming around to the fact that rate cuts are not really on the table as much for this year as they thought. And I think about a month or two ago, the market was expecting 4 cuts by the end of the year. Now the projections are down to 1. I think they'll be surprised if we get that one as well. Mark, if you go to the next slide. I think when we think about the European Union, I got this one wrong in the near term because I thought Europe was going to have much more severe problems right out of the blocks. I think the member nations have been much more adaptable and resilient than I thought. They've overcome what I consider as terrible policies on the energy transition. Not that their intent isn't right. I think the planning was naive, and I think it was not well managed. But I think the weather situation helped out quite a bit. I think the amount of stimulus that they've had in place over the last several years has been a very positive thing to help ease some of the pressures on the system. I think the labor market has remained quite strong, but I think really the issue is you had an improvement in business confidence, but I think that was weather related. And now you're starting to get the reality of what's coming. And I think what's coming is further challenges in energy, persistently high inflation, bad government balance sheets, which crowd out spending. I think you still have the historical institutional design flaws of the EU that are going to hold them back when you have a monetary union, but not a fiscal union. I think it's very difficult to execute the programs that they need to. And I think they're seeing government finances stretched in a way that are difficult. And it's not just the smaller nations now. I think what's going on in Italy is a problem, depending on how their election turns out. I think what goes on with the Turkey election will have some weight on Europe as well. So I think those are some of the issues we're looking at there. Mark, if you go to the next slide.
Yep, 1 second.
But you can see the European GDP has improved. We're going to move through these quickly, Mark. So a little bit of a rebound there, but it's still off a very low level. If you go to the next slide, Mark, you can see how inflation is coming down, but still is persistently high at 0.6 on a monthly is still too high a number. So that has to come down. And what's happened that's helped this is the government subsidies have taken some of the pressure off the system. But I think that is going to be one that becomes more problematic as we move into the rest of the year. You go to the next slide, Mark. You can see that they're doing this with declining confidence. And I want to share with you a study that came out today, and it really speaks to what my big fear is and what has surprised me about Europe so far, but it's starting to come home to roost now, is I think there's a lot of concerns from business leaders in Europe about the loss of competitiveness. And I think that's a real issue. And to give you a sense, there was a survey conducted by the European Roundtable of Industrialists and the Conference Board. And it said that some 57% of company chiefs across European multinationals are eyeing shifting investments or operations or both across the Atlantic over the next 2 years. More than 80% said they believe Europe is losing competitiveness as a base for industry due to geopolitical risk, inflation, and energy costs. And I think this is a real issue as companies like BASF and other of their leading countries are really worried about the industrial base being carved out over the next couple of years. I think this is one of the big concerns I've had, why I think I was too negative in the short term, when I think this will play out over the longer term. If we go to the next slide, Mark.
Oops. Yep.
So I want to get to the China reopening, which was really very different than I think most people expected and was different than I expected. I thought it was going to be like 2008, where China came in and was really going to focus on stimulating the global economy. What's happened, I think, in the major difference now and then between then and now is then it was all about globalization and building up China's customer base around the world and becoming the manufacturer to the world. What's shifted now is a much bigger focus on stability and security and quality growth and moving up the value chain rather than being big to be big. And I think a lot of that has to do with the shifts that are going on in the Chinese economy right now. And I think you have a couple where you have some very positive tailwinds with pent-up demand and the reopening and a lot of opportunities within the domestic economy because of the lockdowns. But you have and to go with that, the growing middle class. You also have China's dominant position in critical technologies and commodities, as well as their manufacturing model. And they're viewed, quite frankly, as a more positive alternative for a lot of non-Western nations for an alternative to the Western model of democracy and capitalism. The Chinese model has a lot of appeal, particularly if you're more of an autocratic state. But I think on the headwind side, they're coming to roost, and they're coming to roost quicker than I think people thought. The demographic issues are real and they're present, and they're slowing the economy now. The real estate problems are starting to really get magnified. They've been with us for some time, but the bill comes due at some point for high debt problems. And I think that's bleeding into a local government finance problem, which is creating further social stresses. At the same time, the Belt and Road Initiative is getting pushed back. And now foreign corporations have to determine how do they want to participate in China going forward. And a lot of that will depend on whether you're a company that is going in the areas where the Chinese government wants to be a dominant player, or you're going within areas where they're open to competition. I think that is creating a shift of capital. So when you have the Chinese economy and the European economy with corporations rethinking where they're going to house their businesses and how much foreign investment are they putting in and where their investment going, I think that creates a very different environment than we've seen. And I think this has been a bit of a surprise where China's not doing more for the global economy and doing more to help themselves. So Mark, if you go to the next slide, please. So what you're seeing is the China recovery was kind of muddling along with the lockdowns, and then all of a sudden they reopened, but you're starting to see industrial output decline and retail sales starting to soften. And as you see that happening at a time that the economy should be taking off, those are not typically good signs for the strength of the economy. And I think part of this is that the country's focused on quality growth and they're focused on stability, so they don't really want to see the big swings and the big fast moves in the markets. They want to see more stable and steady growth. Go to the next slide, Mark. I think this is one of the big issues that China has to deal with. They have a lot of unemployed graduates, which is terrible for growth and productivity. And what you can see here is the urban unemployment rate of 16 to 24 years old is now above 20%. And a lot of those are well-educated students who are going to be frustrated with the lack of a job. And with tighter controls going on in the country, I think that becomes a bigger issue. So I think this is one of the areas where the demographic cliff and some of the slowing growth and the shift that's going on in their economy is going to be a big problem. And I think this is where the social stability really comes home to roost. Mark, if we go to the next slide, I'm going to wrap up pretty quickly here. So I think it's time to move to the other side of the boat. I think a lot of people were focused on investing in the same areas coming out of this, and we've had a lot of disruptions this year. But I think what you're going to see is, from a country perspective, the U.S. will be the best of the bad lot. I do think there are countries in like Canada, Mexico, and some in Asia that are going to do well out of this. I think some of the Latin American countries, particularly those that are commodity producers, may do well, but they have some geopolitical issues that they have to work through. India always is an exciting area to invest, but they have the issue that some of my favorite sports teams have. They have a lot of potential, but they never live up to it. I think the transitions that are going on with China and Europe bear watching. And while that's going on, the U.S. remains, I think, a safe port in a pretty stormy environment. So I think that's going to move capital back here. And Mark, for the last slide, if we go to where you want to invest in this environment is away from the consumer, away from weak balance sheet companies to the places where there's guaranteed spend from governments and corporations. And in the US, that's around the Infrastructure Act, the Inflation Reduction Act, the CHIPS Act, and the National Defense Authorization Act. I will say that the Inflation Reduction Act was a real wake-up call for European businesses to think that the US is creating industrial policies such as they accuse China of doing. And I think that has Europe rethinking their industrial policies very differently now. But I think these changes are really defining where capital is going to flow and how businesses are going to apply their capital and which regions they're going to apply it to. So for us, we see a lot of capital flowing to the US, but Europe has a number of opportunities that they are taking advantage of. They are leaders in the clean energy transition. I criticize them for being a little too ideologic, but that is going to serve them well over time. You're just dealing with the pain up front. I think there are other opportunities on the industrial side that they can continue to take advantage of. And there are pockets of their industrial base that they can continue to leverage while they're bringing more technology into it. But I think they have a demographic problem as well as China does. But when you get to China, I think where you think about investing there is they're investing in the same things we're talking about: national security, advanced technology, and building out their domestic economy so they're less reliant on the rest of the world. I think the big issue for China is, do they want to play and partner with the US and Europe, or do they want to be divide the world up and be adversaries and be in conflict with each other? I think where we go from here is going to play out around that major central issue. And that will go back to how does the war end in Europe? So I see a real opportunity to invest where there are necessary spends going on in this environment. I think you want to be away from where the crowd is. And I think when we get into certain hot dot areas, I would be very cautious of it in this environment, because I think you're going to see that the economy doesn't work the way we think it is, the way we thought it would between now and the end of the year. I think this recession that's coming may be of a very different character than people were anticipating. It could be a much softer recession than people think. If that happens, you can see a very different rebound in the economy. But I think we're going to see growth be somewhat stagnant, because I think it is a tale of two cities, where you have the necessary spending going on that you can invest in and benefit from, while you have high debt loads and interest costs that are going to really weigh on the less fortunate and the weaker balance sheet countries, companies, and households. So, Mark, we'll stop there and open it up for questions, and left time for you to get to the next group as well.
Thank you, Stephen. And well, Henry, you've had your hand up. You wanna-
Thank you, Mark. Great to see you. Hi, Stephen. Good to see you as well.
Hey, Henry.
Let's focus on the China story for a second. So obviously, China had a hard lockdown for about 3 years, sort of isolated from the world. And there's a lot of pent-up demand as the economy is opening up, Chinese economy. Not without issues. A very big country, with debt, real estate, so on and so forth. What's catching a lot of attention, at least in my eyes, is the very high unemployment rate for the 16 to 24-year-old. I mean, quarter. I remember seeing that for for any sort of advanced economy. But anyway, with that said, I can see maybe potential social unrest or maybe even brain drain, right? What are your thoughts over the next 5 years in terms of Chinese economy? Bullish, bearish? What do you think? Thank you.
I think you can be both bullish and bearish, because I think you're going to see pockets where there's real opportunity to invest, where the government is telling you that they want national champions and global champions. And you can also invest away from there where the government doesn't really care. So if you're, maybe a Starbucks or somebody, that's not a national security issue for China. They're not going to be worried about that. Like they might be a chip company or a Micron. But I think the idea that China is going to overtake the US as the #1 economy in the world, I think really should be called into question now, as not a guarantee any more than it was a guarantee that Japan would pass the US back in the 80s, when everyone thought that was going to happen. And I think the issue of demographics, both for the strains that it creates on the overall system, because you have a rapidly aging economy with not enough young people coming into it, but also the social strain of young people being unemployed at that rate when they're well educated is a real problem. And I think those issues combined with the debt issue, if they don't get that under control, will determine the fate. I do think China's taking the debt issue very seriously, which means slower growth for the global economy as they try and work down their debt problems in a manageable way. But I think there's real tension there. And I don't think it's a given that China can pass the US without partnering better with the West. So I think a lot of it will determine what their geopolitical views are going to be.
So before VJ and Mark speak, I'm still dumbfounded by this high unemployment for the youth. What, does anyone have an insight on this? If not, we'll move on.
They're not creating enough jobs, only 12 million a year, and they're graduating something 11.5 million students from higher learning institutions.
Yeah, I also think there's a mismatch between the transition from the factory worker jobs to moving up the value chain, Mark. They lost a lot of the low-end jobs to other nations in Asia that can produce at a lower cost because they were raising their wages so aggressively. And I think that mismatch is part of a transition that takes some time, but you gotta fill that void, and that void left unfilled for an extended period of time creates big economic scarring and slows economies down considerably.
All right, Mark Lepresti, your hands up.
Sure. I just wanted to ask Steve, first of all, incredible briefing as always. You've said to avoid anything that involves the consumer. I've been talking a fair amount on the various programs that I do about the trade down trade. So like folks have to spend money on essentials somewhere. So we went for example, in terms of dining and entertainment, we saw from fine dining to fast casual to quick serve down to like outright fast food. We've seen from like Lowe's and Home Depot to Target to Walmart. Walmart, reporting last week exceeding expectation because the groceries there being cheap. Like I'm looking at the dollar stores again. Do you believe in the trade down trade, or is your recommendation like just avoid the consumers at all costs because there's better places to make out?
I think the trade down trade we're participating in too. So the Target and Walmart and Hanger we would have in some of our client portfolios. So I do agree with the trade down, but I just think that consumer spending overall in the US is a consumer driven economy. I think you will see discretionary spending change and go to more experiential stuff. So I do think there's opportunities there because we still have pent up demand. All you have to do is look around at, bars and restaurants in New York City on a Thursday or Friday, and the people are still spending. But I think the goods spending is going to be way down. And I don't think you're going to see the consumer. I think they're starting to feel the pain of the 5% and the higher interest rates. So as I look out, I think you have to be very selective there, as you had mentioned on the trade down. But beyond that, I don't think it's going to be a great environment for consumer-oriented companies.
But on the other
Thank
side,
you as always, my friend.
Mark, he does believe in the digital transformation and a lot of things that you're, focused
Yeah,
on.
I think data is going to be just incredible opportunity for people and how we use it.
Andrew Randak, I can't see my chat. It just said Andrew Randak shared a file. What did you just share?
Hi, good to see everybody. Thank you. Sorry, I jumped in front of you, Wanda and Mark. I'll answer this very quickly. It's a graph published by Strategas this morning, which they call the Consumer Stress Indicator, which is a combination of food at home plus mortgage rates plus gasoline prices.
Got it.
And thought it was interesting and relevant to today's conversation.
So, by the way, we had David Hinkle in Ohio, the second or third loudest man in Chile. Wanda.
I want to go back briefly to the high unemployment rate in China. Anecdotal information through my involvement with Stony Brook University on Long Island that has a very strong science school. that educated a lot of young Chinese people. So anecdotally, some of the students went back before the lockdown, and I personally have received number of contacts from these students who are looking for way back to the US. They went very excited to China, and perfect storm happened. Reverse cultural shock. So what I see is a back influx, if you will, of the Chinese who will be able to secure, again, visas for advanced studies, also the opportunities for the businesses that want to have highly educated young Chinese people with all the luggage that goes with it, political, legal, and so on. But I was able to place one of such students with the business that wants to expand to China. So I would keep my the eyes open for those who have China on the radars for highly qualified labor coming from China again. Thank you.
Yep. Vijay, last question. Thanks.
So, 2 points, Stephen. Thanks for your presentation. What's your perspective on the Silk Road? Because look, they're investing. The Chinese have a strategy which has been underway, and the Americans and most of the West have been watching it. The investment in Africa is huge, and there's also been a huge export of people to help build roads and infrastructure in Africa. Although we noticed the buildings in China stopped being built, a lot of cities now have been left empty and stranded. So my point is, what's your perspective on the two-track strategy, the Silk Road, and what the West is doing to do it? And just the other point was on Europe. The figures don't quite tell the true story of the cost of living crisis. You've seen the uproar in France. Macron had a huge meeting just a couple of weeks ago where he's inviting everyone to invest in France. And in the UK, we're hiding our food banks compared to McDonald's. So just do a quick question. Sorry.
Mark, I'll answer the second one quickly. The cost of living issue in Europe is real, and it's going to get worse. And I think that's part of the reason I'm surprised it's done as well as it has. But I think a lot of that has to do with some of the subsidies that were put in place, which that just strains the government finances more. So I think it's going to come home to roost on the latter end. I also think that the first part of your question again, I'm sorry.
The Silk Road strategy.
I think it's alive and well, but I think it's going to come back to haunt them, and that you've already had a couple countries push back on them in a way that it has not created the positive feelings after the loan has happened that you had before. So I think that creates some negative views. But they've seen the U.S. mess up relationships before and stayed in for the long term. So I think it's going to create some issues, but it's going to force countries to decide who they're going to align with. And I think some people are going to decide to stay with it and some are going to move away.